And welcome everybody. My name is Ben Nash and I'm a financial advisor and my business Pivot Wealth, we help people make smarter investing decisions so that they can basically live epic lives, I suppose. Can you guys just throw into the chat, just confirm that my audio and slides are coming through okay? G'day, Fred. I think that means you can hear me. Perfect. Thank you, Prudence. Appreciate that. So guys, thank you. Cheers. And great to see so many people on the line today as well. Yeah, really sort of pumped to get into it. I think that personal investing, is really critical if you don't want to be forced to work forever. And some people might choose to work forever and that's all fine. But investing is what gives you another income source so that you're not forced to work, and then you can work out of choice and follow your passions. So I'm going to dive into some of the real sort of basics today, and then build on that, talk you through different types of investments, some investing strategies, and then I have some time for Q&A. I'll do questions as we go through as well. So just pop any questions into the Q&A. I'll sort of pause as we go through and get to those, as well as have time at the end. So guys, but firstly, just a special shout out to event partners, Legends at General Assembly, for hosting today, as well as Self Wealth, an online brokerage platform there. Got a really slick sort of user experience, doing some great stuff. So if you're not already around their stuff, check them out. Yeah, they're both these guys are really supportive of empowering people through knowledge, which is really closely aligned with our philosophies as well. So guys, please don't rush out and make any life-changing decisions off the back of what we covered today. I strongly encourage you to seek out some good advice before you jump in. Investing decisions, big decisions that are difficult to unwind, so you should be thinking about doing that anyway. So I just want to start with a bit of an example that shows why investing is important. And by way of background, what I've done here is I've started where a lot of people think that you need a lot of money to start investing, but I've got an example here and there's a bunch of numbers, so apologies in advance for that. But essentially starting with $0 today, if you start investing and just regularly investing into the share market average. So what I've used in terms of the return forecast for this is the 25-year return on the Australian share market. So if you see the finance section of the News at Night or online or wherever you consume your news, you'll see that they say like ASX has gone up by 1% or down by 1% or whatever. Basically, the cumulative return of that over 25 years is 8.7%, which is the number that I've used here for this example. So if you start saving and then investing $1,000 a month that would be 12 months in the year, so $12,000 each year. And then over a 10-year period, you would have put in $12,000 each year, 10 years, $120,000. But when you invest into shares, you get like dividends on the shares, so you get some income return on those, and then you get some growth, like the shares go up in value. So we know that the past doesn't predict the future, and I was never here, this never happened. But if you would have done this in the last 10 years, then the return would have been roughly that your portfolio would be worth about $190,000, which is like a $70,000 on top of the 120 grand that you put in. Hopefully everyone's following those numbers, but it essentially shows that, yeah, that savings rate. But then if you can keep that going for another 10 years, so 20 years in total, you see that you now put in $240,000, but your return is gone up by to like $400,000 in money that you've made and $600,000 in total. See 30 years, 1.7 million, 40 years, 4.2 million. So you see that you can build some pretty significant momentum over time by just saving and regularly investing. And this is investing into I'm going to say, boring old share market average, not shooting the lights out with every investment, not picking the next Afterpay or meme stock or whatever, but essentially just investing regularly into the market itself. Then I've done another example and saving $2,000 per month instead of $1,000 per month. And you can see that the numbers all pretty well double along here. But you see that, and saving $2,000 is, no doubt it's tricky. That's a decent chunk of change. But if you do that, you getting like $8 million over 40 years, $3 million in 30 years, it's a pretty significant amount of wealth. And then I've got the $3,000 a month, and you see that it just escalates even further. So this is the power of time, and it's the power of getting started. Now, some people don't have 40 years to invest with their timeline, and that's fine as well, but it'll give you a sense of how things build. And what you probably notice is that the returns tend to escalate. It's like this exponential growth over time. That the biggest benefit that you get on your investment is at the back end. And the implication of that is that the sooner you get started, the better the results are that you get. So it's the power of time, but it's also the power of getting started. So I hope you found that one helpful. The challenge is, though, that people, when it comes to this stuff, that there are some common challenges that people face. People, that everyone's situation is unique, but when it comes to making money decisions, there are these three key challenges that I see people facing, which is the information overload. So it's like there's so much information out there, so many options, that it's almost like we're drinking from the fire hose, and it's hard to know who to listen to and who to trust. The second one is that people really struggle to find balance between getting ahead financially at the rate that they want while they live the lifestyle that they want. And you sort of you're often trading off one against the other. And then there's the FOMO, which everybody knows, the fear of missing out. And there's so much psychology that impacts how we manage our money and how we invest. But then there's the FOFU, which is the fear of effing it up, essentially, the fear of making a mistake that is going to cost you a bunch of money. And what happens is that people end up stuck. They end up stuck, not only stuck doing nothing, but sometimes just stuck doing the same thing that they've been doing in the past. And what that means is that they're missing opportunities to be getting better results and getting more out of what they have now. So today we're talking about investing 101 and investments, although I'm going to sort of tie it in with some of the other elements of strategy and structure. But these three elements are all definitely mission critical to being financially successful. And if any one of them is missing, it ends up dragging down on the others. So the ones that I've got there, structure, which is about making it easy to save and manage your money, as well as making it clear how much money you have to invest or pay down debt or whatever other strategy that you've got. Strategy, which is having a clear investment strategy, having a clear overall money strategy where you know where you're headed. It's all achievable. You can see the pathway, you know that it's an achievable pathway to get there, and you're not leaving any money on the table. And then the solutions is the investment solutions and the products that you use to back up your strategy, making sure you're getting that reliable, consistent progress over time and avoiding the downsides and setbacks and those momentum killing mistakes. So like I said, sorry, just going back for a sec, that if any one of the elements is missing, it ends up dragging down the other. So if you've got the structure and strategy, but you've got bad investments, you blow up your cash. If strategy is missing, you end up leaving money on the table, leaving a bunch of confidence on the table. And if you're not nailing your structure, you're working with a leaky bucket, and it's really hard to make good investment decisions that you can be confident that you'll follow through to get the results that you want. So we'll unpack some of the hacks and frameworks around that. But first, I'm just going to dive into investment basics. And guys, if you've got a question and you're following along, chances are that somebody else does as well. So feel free to just pop that into the Q&A, and happy to circle through. But in terms of different investments, you've got these are like the share type or equities investments that you might hear people refer to that term, equities. Essentially, you've got shares, ETFs, managed funds, and things like micro investing apps. Now, when you buy a share is simply you're buying a really tiny little slice of a company. So you could buy a share in the Commonwealth Bank and you would own a tiny little fraction of a percentage of Commonwealth Bank. You're entitled to that same percentage of the growth of the company over time. So CBA's got a certain value today. You know, over time, they're engaging in business activities and looking to increase that value. And as a result of that increase in value, you benefit from that as a shareholder in the business. It's where you buy a share in one specific company, you benefit from the growth. And also when CBA makes a profit and it pays out what's called a dividend, it pays that out to the shareholders. And you, again, if it pays out $1 billion, you'll receive your little fraction of a percent of that $1 billion relative to how many shares you hold in the company. ETF, or exchange traded fund, it's something that's quite in vogue at the moment. That it's essentially a bundle of shares where you own a little slice. It might be 20 or 100 or 200 different shares, and you own a small slice of each of those shares bundled up together. Now, ETFs can be quite good in that it gives you, it's not like if you invest in CBA, the return you get is only in CBA. And I'm going to talk a little bit more about diversification, but your whole portfolio return is based on that one company. Whereas when you invest into an ETF, because they're generally investing into a number of different companies, then you smooth out your return over time because the highs of one balance out the lows of the other. The next option that I've got here is managed funds. And for people that are investing in managed funds, that's where there's a big pool of shares, a big pool of people and money that then go invest into shares. And I should call out, because it does get quite confusing and it also gets a little bit technical, but exchange traded funds versus managed funds, they are quite similar in terms of what they do. The difference is that a managed fund, and again, it gets a little bit technical, but just so I don't leave the question unanswered, managed fund is a pooled investment where if you invest in, say, a Vanguard's the second biggest fund manager in the world, we use a lot of their stuff. They've got some really great investments out there. If you invest with Vanguard, you send them a check or you send them a wire transfer or whatever for $5,000. They get you $5,000 and they invest it in line with the investment mandate of whatever investment option you choose with them. Vanguard also offer ETFs. So you could invest in the same Vanguard ETF, but with an ETF, you buy it on an exchange like SelfWealth or CommSec or Pocket or E-Trade or something like that. And you're actually buying that little bundle of shares which already exists. With a managed fund, you put the cash in and then they go out and buy the shares so that you own them. With the ETF, the bundle already exists and you just purchase that bundle of shares. Now, because you're purchasing a bundle of shares that already exists and then you own exactly what you own, there is a slight difference in the tax outcomes from ETFs versus managed funds. With an ETF, you typically, if the portfolio remains unchanged, if the underlying investments remain unchanged and you don't sell your investment, you don't incur capital gains tax. That's the big one. With the managed fund, though, because you're putting in money and then they buy shares on your behalf, and then if you want to take your money out, they sell your shares, get the cash, send you your cash out, but then you realize capital gains. And those capital gains are distributed across all investors underneath the fund. Let's say it gets a little technical, but one thing that all of that being said, I don't want to say that there aren't differences, but if you're not investing 7 figures or more, like into the millions, you're probably unlikely to notice much of a difference between ETFs and managed funds. So it's almost like a bit of a what's easiest for you, what fits with the investments that you want to choose. And I'm going to talk more today about how to choose and what some of those choices are. The final option that I've got here is micro investing apps, and this is something that's getting more and more popular. And I think it's actually really great that it is getting more and more popular, where it's like the companies will give you access to fractions of an exchange traded fund or a managed fund, typically, or a share. They have micro investing apps directly for shares as well. So that allows you to invest with as little as maybe $5, or maybe in some cases even less than that. I'm not 100% sure. But you can, if you want to buy a share in Google and it's cost $10,000, you can just buy $5 worth of that share, which is really handy for people that are earlier on in their journey. Plus, it's also handy if you want to get diversification. And yeah, there's some pretty schmick user experiences on those tech tools as well, which can be a great way to educate yourself about shares and your options and in investing generally in markets. Investment options, and I'm not going to talk too much about property as well, but given we're talking personal investing 101, that there are property investments that you can access, which is regular run-of-the-mill residential property. Then you've got commercial properties. That's where you're buying like an office block or a factory or a shop or something like that. Typically more expensive, but have a bit more on the income yield side of things. There is also a bunch of fractional property investments. There are investment platforms out there at the moment. BrickX, Bricklets, seem to have something about bricks when it comes to this stuff, but essentially buying little parts of properties, and there are a whole bunch of different ones there. Look, I think that this space is getting more competitive and more of that is coming along. But in my view, the options out there at the moment are currently, there are probably a few downsides that I think can suggest that oftentimes the benefits are not outweighed by the risks and trade-offs. So you have issues with liquidity, and what I mean by that is if you buy into a fractional part of a property and someone else doesn't want to sell, then you can be the one that's left holding the bag with that, and it can be, create some risk and challenges as well. With that though, I think it's horses for courses. So it depends on what you're doing and what's right for you. And I'm going to talk about how you can actually plan with that as well. And I'll put a solid plan around that, I should say. And then the final one that I've got in the list is property investment funds, whether they're ETFs or managed funds. They call them real estate investment trusts or REITs. You may have seen these in your travels if you're looking around the internet at the investment options. But essentially they're buying typically commercial properties, but it's like you can put a bit of money in, it gets into a pool, and they go out and buy a bunch of properties. Tax planning is one of the basics that you really, really, really need to understand. I can't stress this enough, because in Australia, we pay a lot of tax already. And obviously, the lower your ATO donation is each year, the more money you've got for your savings, investments, asset and wealth building strategy. So you should be aware before you invest that, might have this in a future slide, but you should be aware before you invest into tax implications, because it is really difficult and expensive to unwind things in the future. The first thing that you should be aware of is marginal tax rate. So in Australia, we work under a marginal tax rate system for individuals, where your income, like the first $18,000 of income that everyone earns, you pay 0% tax. Then the amount above that to $37,000, you pay 19% tax. And then it goes up and up and up to the 47% top marginal tax rate, but incrementally. Now, what that means is that if you're already earning more than $37,000, you're paying at least 30% marginal tax rate. And you only get one tax scale. This is something that confuses a lot of people, that there's not a different tax rate for investments versus your employment income versus your sole trader income versus any other income sources. So if you're already earning more than that $37,000 mark, then every dollar of investment income you receive that's held in your personal name is going to be taxed at your current marginal tax rate and contribute to a tax obligation from the ATO at the end of the year. So beware that when you think about investing and your investment return, that you should be thinking about your after-tax investment return, because that's really the most important number. It's great to have a great headline return, happy days, but really after you pay the piper, it's like what you're left over with, that's the actual return on your investment. And there is a difference in how you can structure investments. So you've got marginal tax rates if you own investments in your personal name. You can use trusts and investment companies, and I'll circle back to that. They have different tax rates. And then you can invest by your superannuation, where superannuation has a maximum tax rate of 15%. So you can see that you're already saving a pretty significant amount of tax dollars in doing that. Now, superannuation in particular, there's a trade-off that when you put money into super, you can't access that money for a whole bunch of time. So you need to make sure that you're not investing things that you're going to need next week or month or 10 years from now, even depending on how and when you can access your super. But super is a thing. And then trust and investment companies are another quite interesting one, that as you build your wealth more, these things are absolutely not for everybody, but as you build more wealth and assets, that they can make a lot of sense. How a trust works is if you own a share portfolio in a trust, and trusts are triangles in financial planner land, which is why I do the triangle. But when you own a trust, the trust owns the shares, and then each year the trust is required to distribute whatever income the investments, the underlying investments actually generate. So if you've got a share portfolio in your personal name and it generates, say, $10,000 a year in income, you have to pay tax on that at your marginal tax rate. If you have it in a trust, then the trust needs to distribute to another taxpayer. So it can, if you own a trust, you can distribute it to yourself and you'd be in the same position as if you owned the share in your personal name, or you could pay it out to somebody else, like your partner, your black sheep cousin that doesn't have much of an income or much of a marginal tax rate, and then they pay tax. And if they're on a lower marginal tax rate, then there is a tax planning strategy around that. Investment company is another quite interesting one where you can, because companies and investment companies in particular have a flat marginal tax rate of 30%. If you're investing into via a company, and especially if you're on those higher or the top marginal tax brackets, it can be the difference between paying 47% tax versus paying 30% tax, which is significant as your income gets more and more significant from investing. So I mentioned that it is difficult to unwind or change things with your investments over time. So it's important before you invest that one of the basics and the fundamentals is understanding the tax implications and then choosing the right tax structure to hold your investments. How you can invest. So there are different ways if you want to invest into shares and ETFs, managed funds in particular, that you can access. So you can invest directly into shares via like a CommSec or SelfWealth or online brokerage. You can use a stockbroker, where a stockbroker will actually help you invest into shares. So they will give you some recommendations, actually execute the trades and set the investments up for you as well. You can use a financial advisor, and we have access to products that we can help people set up and then manage on their behalf in their name. I'll talk a bit about that in the risk section as well. But you can use a financial advisor. Part of the reason that I put this up, though, is to say that you don't need to use a financial advisor. You can invest directly. You can use other options there as well. And then the final one that I've got here is investing with family and mates. And I've found people that have done this in the past and it has worked, and that can be great. But a lot of times it can get quite complicated, and it means that you're sort of in the boat together for potentially an extended period of time. So if you go down that path, investing with family members or people in your network, just make 100% sure that you've done your due diligence and you guys are 100% aligned on the strategy moving forward, and that you're aware of the implications of investing with other people and what that means for some of the other financial decisions that you might make. So the COVID impact on investing and investment strategies, look, there has been, you can't deny that there has been some structural change in the economies and different markets. The property market has been significantly disrupted. The work from home trend, move to regional areas, ultra low interest rates, property prices going through the roof, all of this stuff is a thing, and a thing that you need to factor in with your investment strategy. We're getting a lot of volatility as well, a lot of ups and downs in the share market, in the property market, a lot of ups at the moment, a lot of volatility in all markets. And there's some economic risk as well around, like, the government have been plowing money into the economy, to individuals through the COVID support programs, the business support programs, all of these things, that there's artificial money that's out there. Do I have that on my next slide? Yeah, artificial money out there, but a lot of businesses are still doing quite well. I heard an article today on the radio about the number of businesses that had tripled their revenue during the downturn, and they were talking about the JobKeeper payments, which is clearly an issue. But the fact that there's so many businesses doing so well means that their business is good, wage growth is good, unemployment is not that high at the moment as well. So the economy is, while it's good, it is sort of like a false economy, because a lot of it's supported by the government cash splash as well. But that being said, it's these periods of time it makes millionaires. It makes the people that have built significant wealth. If you look at the periods of time where there have been economic downturns, it's where they make the most money. So it's scary to do that. And I'm going to talk about how you can plan and give yourself a lot of confidence around your planning and money moves that you make. But there's a huge opportunity out there if you're smart and you're dotting your I's, crossing your T's, fighting your inner psychology and inner investor, and making some smart decisions with that long-term view. But that solid planning is critical, and I'm going to unpack that. So I can see there's a bunch of questions here. So I'll just run through a few of these now. Tobias has asked, is this based on ETFs? And based on the timing, I assume that that's for the initial example that I showed around the numbers. Could be ETFs, could be managed funds. Tobias, it's either or. The return profile is pretty much the same on those ones. I'm going to actually talk specifically about the stuff that I was mentioned there as well, so you get a bit more context there. Someone's asking, is it better to invest in ETFs in AUD or USD? Well, that's a tricky question to answer, although the simplicity of reporting, if you're an Australian tax citizen and an Australian tax resident, there's value in keeping everything easy from a reporting perspective. If you're a US tax citizen, then it does get quite complicated. In that case, it can be looking at US domiciled investments makes reporting easier. So that can be a consideration as well. Also be aware that if you're investing in other currencies, you introduce currency risk into your portfolio on top of just the regular equity market risk. Will there be an e-certificate? I don't know. I don't think so. I'm not sure about that one. Might have to refer that to the GA people. Vinny asked about, does the example of investing 1, 2, 3K a month apply to a diverse portfolio to get the benefits from compound interest? Vinny, yes, it absolutely does. And I'm going to jump into that a bit in a sec. Sogand, I hope I'm pronouncing that right, says, are listed investment companies managed funds? That's a good question. The listed investment companies are not managed funds. It's an investment company which is owned by other investors, essentially. So it's like a public listed investment company. So it's like the same investment company that I mentioned in the tax planning section, but it's just listed on the stock exchange and anyone can buy into it. So it's similar, but it's different. Same question about listed investment companies, yeah. And one more question, and there's a lot of questions here, so good one, guys. Keep those coming. I might just have one, and then I'll move on to the next bit and circle back on these questions as well. Question: if you're saving for a house deposit today, say over 3 to 4 years, and start a longer-term compound interest investment strategy, would you invest your house deposit savings into lower risk shares? That's a really good question and a common one that I get. The thing is, when you invest in the shares, you should have the ability to hold your investments for 7 to 10 years or more. So, and the reason is that if there's a significant economic downturn, that the history has shown that it's that 7 to 10 year period that really sometimes it takes that long for the markets to recover. So investing money that you need in the short term can be quite risky, because if the markets are down and you need the money, then you're forced to sell, you end up losing a bunch of cash. But if you want a house in 3 to 4 years, but you don't need a house in 3 to 4 years, and you're prepared to delay that purchase by a little bit longer, then potentially you can invest into shares knowing that there is a bit of risk there, but the risk is managed by the fact that you can just delay what you're doing, hoping that in the next 3 to 4 years that doesn't happen and your shares go up, and then you just exit out, make a bunch of money, and then make your next step easier and don't have your money sitting in 1% cash in the bank over that period of time. I hope that one is helpful. I'll just, because I'm just a little bit mindful of time, so I'll push on with this section, and then I'll circle back on the questions and try and get through as many as I can. I'll give you the quick version of this, but all of that investment basic stuff is really important. But when you're investing, and this sort of ties into that last question around and I'll sort of wind it back to some of the philosophies, but you're essentially looking at, do you allocate your money to, whether it's savings or your regular savings or a cash pool of savings, to your saving today or saving in the future, spending in the future. Your future stuff is your savings and investments, but because you've got shares, managed funds, ETFs, property, super, these are all things that tie up your money for a period of time, as per that question that we're just talking about, that the key to making smart decisions and assuming that you use good investments here is that you need to make sure that that you have the right time frame to let good investments do what good investments do over the right period of time, which is make you a bunch of money. Now, I'm going to talk about how to choose good investments as we go through today, but just know for now that the key is so long as you've got good investments, then the key to making good decisions is knowing that you never need to move money from the today side of the ledger to the future side of the ledger. And how you do that is making sure that all of the future stuff is provided for. There's only so many types of expenses that people have. You've got your fixed costs, bills, rent, the boring stuff, spending, debt, lifestyle. If you know that all that stuff is provided for, then you can let your good investments bubble away and make you money over time. And how we tackle this is we just use a bunch of different bank accounts so that you've got the right money in the right places at the right time. All of your spending is covered, and you know exactly how much money you've got to invest, which gives you a ton of confidence with your investment decision. So while this is the least sexy part of an investment strategy, it is really key to knowing how much you got to work with and making really smart decisions around how you plan. So this should be a first step before you start jumping into investments if you want to avoid trouble. With your banking, yeah, we can reduce costs with COVID. Obviously, we're all in lockdown life, so we can't actually do anything anyway. But defense is extra important because of the risk that exists out there. And cash savings is quite risky because of the low interest rates on cash savings as well. So I'm going to get into I'll give you the quick version of the different sort of fundamentals of investing as well. But essentially know that you can only manage risk that you understand when it comes to investing. Now, that sounds like a bit of a weird statement, but essentially risk is what makes you money when you invest. You know, investing in shares is risky, investing in crypto is risky, investing in property is risky. Doing nothing has risk attached to it as well. And the key to making really smart investment decisions for you, and those decisions are different for every single person that's listening along today, is that you need to understand where your risk is coming from, what those risks are and how you can manage them. And then once you know how you can manage them, you'll always have some risk left over. And with the risk that's left over, you need to decide what risk is right for you and what risk is unacceptable risk. So we avoid the unacceptable, cram as much of the acceptable stuff into your plan as possible. That means you're going to make the most money possible while being comfortable with what you're doing. So talking about some of the risks and things to be aware of, the first is the split between your defensive assets like cash and fixed interest or investments versus growth investments like property shares, Australian shares, international shares. Defensive investments are called defensive because they have less risk of going backwards. They're stable. You know, cash is government guaranteed in Australia. Fixed interest is like bonds and term deposits that are backed by assets. There can be some volatility in these investments, but they're stable, they're defensive, they produce an income. And then when you go onto the growth side, you've got property investments. Obviously, the property market is the property market. Then you've got Australian shares and international shares. And to the question before about investing in Australian AUD versus USD, when you invest in international shares, whether it's USD or any other foreign currency, you're not only introducing the share market risk, but you're introducing the currency market risk. And that's why the volatility of international shares as measured by the return versus risk on this graph is a little bit higher because you've got the equity plus the currency side of things. Sorry, going back to this, one of the most important things that you need to get right with your investment strategy is the split between your defensive investments and growth investments. So you need to decide how much is there. Now, be aware that you can have defensive, like your cash in the bank as your emergency fund, and then you've got your share portfolio over this side. That gives you a more balanced approach. It doesn't have to be within your portfolio. It can be on your overall portfolio, looking at all of the different assets that you've got. Investment timeline we spoke about before, that they say 7 to 10 years or more for share investments, and that's because the market downturns that I mentioned. Now, it's not to say that if you invested 12 months ago into the share market and you made a bunch of money today and wanted to go buy a property, you could sell, happy days, and then off you go, do whatever comes next, and you've made a bunch of money. That's all totally fine. It's just that you need to have the ability to wait if that's what makes sense for you. We got good versus bad risk, so essentially small company versus big company risk. And you see that the small companies, which is the orange line, is much more volatile than a stable blue chip company. Think of like your Commonwealth Bank or these sorts of companies where smoother returns over time. And then even within the good companies that are there, we've got diversification risk, and there was a couple of questions about that in the Q&A that to say that, you know, if you've got CBA and then Woolworths and you put them together into a portfolio, you see that the returns are going to be smoother because the highs of ones are going to be balanced by the lows of the other. And then your portfolio return is now smoother. Diversification is a really key risk management strategy. And in my view, something that's really critical to be a successful investor is being diversified, because in the absence of diversification, your investments are concentrated. And if you've got concentrated investment returns, you're holding on for dear life, hoping that you really pick the right thing, and it ends up being a bit of a wild ride. So diversification works really well. I'll talk about some investments that use that in a sec. What I've got here is the share market return overall, which is that 8.7% 25-year return that I referred to in that previous example. We've got we know that the combined value of the 200 largest companies in Australia was $1.6 trillion when I did this slide. This is a little while back now, so the numbers are a little bit dated, but it helps me to explain this. So we knew what the companies were. The CBA was the biggest company in the country, $200 billion, which was reflected 8.93% of this $1.6 trillion number. Then you got Westpac, the big banks, etc. We know what those percentages are. Now, you guys may have heard of index funds or passive funds in the past. It can be a passive ETF, it can be a passive managed fund, it can be a passive listed investment company or LIC, to some of those comments in the Q&A before as well. That so long as an index investment replicates the same proportions, same percentage allocations to the companies that is seen in the share market itself, the return on an index fund is going to be almost identical to the return on the share market itself. So passive index funds are highly diversified because you've got a bunch of different investments in there, but that you also know that the return that you get on a passive index fund is just the return of the market itself. There's no guessing on what's going to be the next winner, crystal ball gazing, none of that stuff. It's just you invest in the market. The alternative is active funds, and actively managed funds are where the fund is looking to do better or differently to the market. So invest in a different way, generally targeting a different return. And the stats show us, like, that sounds interesting, and these companies and investment funds have really shiny brochures, but the stats show that like 85+% of actively managed funds fail to outperform their passive counterparts over the long term. And part of the reason for that is they charge high fees, but also no one knows the future. So if you're relying on someone else to predict the future in tea leaves, then you could be setting yourself up for failure. There are a couple of exceptions to this, that with active funds, if you're getting closer to retirement or in retirement, there's some interesting active funds that invest in a different way to reduce risk in your portfolio. They can be great. And socially responsible or ethical active funds are sometimes investing for impact, and that's a whole different approach, I think, to your investment portfolio, that it's not just about the return. So that's not the benchmark, but where it is about the benchmark, these ones, while they can seem really exciting, they tend to not outperform. And then you also have, for me, these active funds they're stressful because you never know if they're going to do really well or not so well at all. So there are options there, but the key, active versus passive, is one. I'll talk about how to plan in a sec, but one of the key things that you need to decide is, do you invest actively or do you invest passively with your investments? And I've got here a process on how you can plan with your money. This is the process that we guide people through, but it's the same process that anybody needs to use if they want to plan with their money. First step, focus on what's important to you. Second step, clarify all of the inputs or moving parts that are going to impact your plan. What money's coming in, what money's going out, where's it going? All of the assets, savings, debts, all of those things. And then you want to understand what we call your lifestyle baseline is. So look over the next sort of 1, 2, 5, 7, 10 years and say, what are the things that you can anticipate that you need to provide for? Might be starting a family, schooling costs, these sorts of things, starting a business potentially, things that are going to require you to apply money to them. That gives you the baseline that you can then take the next step with, which is layering the strategy decisions over the top. It's like, Do you buy property? Do you buy shares? Do you crank your super? Do you start a business? Is it some sort of combination? So knowing what the financial impact of those different pathways are and how they fit with the lifestyle that you want to do will allow you, you're generally going to be more drawn to one particular pathway than the other. The other part of the strategy is getting granular on things like your investment strategy, active, passive investing, what platform do you use, what's your bank account structure, how do you run your super, all of those sorts of things, so that you know the broad direction that you're going to take, as well as comfortable with all of the stuff that sits underneath it. Then you want to wrap it all into an action plan, which bullet points out what are the steps that need to happen to turn this great strategy into great results. Automate as much as you possibly can, and then ongoing execution, making sure that you're on top of your plan and nailing it so that you continuing to take advantage of all the opportunities that are in front of you. This process, super effective. The ultimate result is you have a clear path to where you want to be, and you know how you're getting there as well. But look, COVID has thrown us, a lot of us, a bit of a curveball. So there is a bit of an impact from a COVID perspective when it comes to planning. You want to be planning fast today. I mentioned the downturns make millionaires comment before. That plan fast. Don't not act out of fear, which is one of the other points there. That fear of doing something wrong paralyzes people, and they're like, oh no, it's this thing, or they put off even the planning process. But sometimes when you go through that, even if you weren't anticipating doing something, sometimes when you go through a good planning process, you realize that you really should be, and there's opportunity there for you. So plan fast, even if you don't be worried about if you do choose to do nothing off the back of your plan. I'd be surprised if that happens, but yeah, there's often the opportunities are there, and it's worth having a plan in place. And then at least you know when your next step is coming. Don't not act out of fear. As I mentioned, education is key. So knowing that you're, understanding your decisions so that you can make informed ones is important. And make sure that you're playing solid defense. That there's that economic risk is out there, a little bit of job risk, a little bit of share market risk as well. So be defensive so that you know that you're not going to get caught short. I'm going to run through myths and mistakes, but I might just field a few questions before I do. One question, what's the minimum amount to be investing via a trust worth it? Is a tax planning vehicle? Look, there's no set amount there. It really depends on what your savings rate is, or and how much capital that you've got and what your pathway is moving forward. So you need to have, if you're not saving, I don't know, if you've got employer share plans and like you got RSUs and stuff rolling through, then or you're saving really strongly, like in the thousands each month, then it can make a lot of sense depending on what that trajectory is. If you've just got a pile of capital, then you probably want to be working, like it's got to be at least 6 figures for sure. I would say that's obviously, this is not advice and I was never here, but yeah, at least that sort of number is where it starts to warrant asking the question, but it really depends on your situation. Nicole, similar question, Nicole, although the one thing Nicole asked, when do you suggest people set up a trust, what criteria should we meet? So the asset stuff that we mentioned above, Nicole, and you also need somewhere to distribute the money to. So a partner, maybe an investment company, ties back in with the strategy there. Hope that helps. Patrick asked, if you hold an ETF for 20 years, do I have to pay marginal tax rate when I sell capital gains tax? Patrick, you pay capital gains tax at your marginal tax rate. So both are true. So you pay capital gains tax as per your marginal tax rate when you sell. And if you've held the investment for longer than 12 months, you get that 50% CGT, capital gains tax discount. ETFs, similar to ETFs, that's right. What are the best micro investing apps out there at the moment? Look, there are a bunch out there. Stake is one, Goodman's is another one, Raise is another one. Those guys are all doing really great stuff. The other one, Stocklight, I think, or something like that. There's a ton out there. But one of the things, I might get into this in the mistakes, but there's actually the same level of security and protection across all of the apps. So you've just got to find one that gels with your approach and what makes you comfortable as well. So Kate's asked, what are your thoughts on platforms like Fundrise? I'm not familiar with Fundrise, Kate. Maybe if you give me some more context around that, I'm happy to answer. Ronaldo says, what to look out for when choosing long-term ETFs, how important are market cap management fees, historical performance? Well, again, it's sort of, Ronaldo, that's a really great question. It comes back a little bit to your strategy. So what is the strategy that you're looking to pursue? What are you, if it's active versus, if you're just investing in a passive fund, then fees can be important. The market capitalization is an interesting one where a bigger fund is something that is going to give you a little bit more stability, and having a track record of being around for a period of time is helpful as well, so you can see what their performance has been. But yes, look at, if perfect world, you'd say a big fund, like large market capitalization or large funds under management, decent management fees, decent performance, and if it's under Australia's Prudential Regulatory Authority or APRA protections, then that's really important as well, because that's where the consumer protection comes from. Danish says, is this the end of my slides? No, I've got a few more, Danish. Dollar lump sum investing versus dollar cost averaging, not really a question, but if you're asking what the difference is, Josh, like dollar cost averaging is about investing small amounts regularly into the market over time. If you're investing a large sum of money, I find that can de-risk your getting into the market a little bit, which can be quite helpful around that. So it really depends again on the strategy. So but I would, when we were helping people in COVID roll out significant amounts of cash, we did dollar cost average over a period of weeks, because then, you're not just chucking it all in and hoping that this time is the very best time to be doing that. I'll push on and I'll circle back. There's a ton of questions, guys. Keep those ones coming. It's really good. So investing myths and mistakes, look, needing to shoot the lights out with every investment. The initial example that I showed you should tell you that you don't need to do that. You don't need to pick the next big winner and run the risk that's associated with that in order to get great returns. What you need to do is be smart, take action, be consistent, and follow your strategy through. Shiny brochures do not equal good returns. So don't get caught up. And when I say shiny brochures, I also mean shiny, flashy websites that some companies are really good with marketing and they don't have a lot of substance behind the scenes. So making sure that you're not just caught up on that is something that can be really costly over time. Investing risk, and this is what I was alluding to in answering some of those questions, where investing risk is not really with the manager of your investments, which sounds a little bit weird to say, but when you invest into a managed fund with, I'll use Vanguard, for example. Vanguard do the administration of your investments, but they never actually hold your money. So even though that Vanguard has got like trillions of dollars under management, it's the second biggest fund manager in the world, it's highly unlikely that they would go bust tomorrow. But if they did, then you would just need to find another investment manager to do the administration. And there's actually what they call a custodian, which is holding your shares so that they're protected for you. So where you can lose money is through the investment mandate of the fund. So if you choose to invest into a managed fund, an ETF, a listed investment company that's investing all into almond plantations or something, and almond plantations go bust, then you lose your money. But if you invest into Vanguard almond plantations and Vanguard go bust, your money is all still just there. Something that people find a bit confusing, and then they're going, oh, is it safe? And do I need to diversify between micro investing apps or between wealth platforms? You don't need to do that from a security perspective. Messy mistakes that people make, making choices in isolation. Any choice or investment can be good or not good, but whether it is good or not really depends on you and how your situation is going to change over time. And so you want to make sure that when you invest, that it's fitting in with your bigger picture, to make sure that everything's working together and in the same direction. Seeking the best option. This is for our engineers on the line, that there's analysis paralysis, trying to find the very best investment. It's basically impossible because we never know until after the fact. And if you waste or invest so much time trying to figure that out on your own, then you end up delaying action and delaying what needs to, the action that you need to start getting some results and building some momentum. And there is no set and forget money strategy out there these days, because everything's changing. The world investment markets and what we want is changing so quickly as well. trying to figure it out all alone is a mistake as well, because it's hard that we fall victim to our own psychology, where our inner investor is a bad one. It's really scary to take action and pull the trigger on stuff without support. So you end up not taking advantage of opportunities there. And when you should be aggressive, you can fall into the trap of being scared and not being as aggressive as you should be. And I'm not saying you should always be aggressive, but in the right circumstances, that's what's going to make you money. So having support is what's going to allow you to do that. And without that support, it can be hard. You end up spinning your wheels. So get some help, whether it's a professional financial advisor, your partner, someone that's done it before. Make sure it's somebody that knows what they're talking about and has done it before, though, because otherwise you can run into trouble. So guys, look, in terms of next steps, I just going to share this model with you, which talks about where you're at today and your progression to the future. And essentially, I won't go into the full ins and outs of it, but essentially says that in this future state, you're going to be in one of four positions, ranging from really bad to really good. The thing is that people think about their progression from where they are to this future state, and they think about it like a straight line. But because of that compounding impact of time and money, it actually isn't a straight line, it's a curve. And if there's some things, if you're not on track to end up in your absolutely ideal, amazing position in the future, there are some things that you need to do to what we call jump the line. You might need to tighten up your investing strategy, to find a few extra bucks to invest, to do the right thing with your super, to cut your fees there, to be smarter with your tax, to do your mortgages, whatever these things are. But when you follow that, when you jump the line and do take that action, then you just need to follow the path and things become easier. But the more time that goes on, the gap between the lines widens, and the more sacrifices that you need to make to get from where you are to where you want to be can become painful, and getting into the best position possible can become impossible. So the sooner you start, if you want $10,000 a month of passive income in your bank account, you need to save X dollars today. If you wait a week, a month, a year, 5 years, you're going to have to save X plus, 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 plus. So this is my motivation talk, to say the sooner you get started, the easier it is to make it happen. And the gap between the lines is the shortest right now today. So guys, I hope you found that helpful. I'll leave you with this quote from Derek Sivers, which says, if information was the answer, we'd all be billionaires with perfect abs. And it's very true. More information is not the answer. What you need to do is to take action. And knowledge is the key to taking that action confidently and getting results. Guys, obviously I'm going to answer some questions in a second, but this is exactly what we do, what we help people with. We help people make smarter investment decisions and work through some of the issues that we've covered today. So one of the things, if we can make your next step an easier one, we do these investing focus calls where it's just an opportunity to talk through what the opportunities are for you. Get a bit of no BS Q&A. You probably noticed from this presentation today that I'm a pretty straight shooter when it comes to this stuff. And understand your next steps. It's literally 10 or 15 minutes, and what you can be doing, what opportunities are out there, and get your questions answered. I've just popped a link for that in the chat box for anyone that's interested. Please feel free to check that out. We'd be happy to chat, and we love helping people make this stuff come together as well. So that is in the chat for everyone now. And I'll just crack in with these questions. Minimum amount to make investing via a trust worthwhile. I feel like we've covered that. Nicole, yes. Patrick says oh no, I've already answered that one. Oh, sorry. Yeah, I see what's happening here. Would you recommend micro investing to start with small amounts? Yeah, look, I think it can be great to invest in small amounts. It can be great also because they have a great user experience and they're really easy to set up. The financial services historically have been pretty average with ability to do stuff and get accounts set up, paperwork and all that sort of stuff. So I think that they can be good on that front too. Peter says, do you think we'll see crypto ETFs in Australia? Peter, I certainly hope so. I think so. I think that is coming. I know in Canada they did this and they've got like billions of dollars in crypto stuff now as well. Yeah, I think it's a matter of time. I know that the guys at Self Wealth are looking to put some crypto onto their platform as well, and just working through the issues around that. So yeah, I'm hopeful that happens soon. I think that it would be really popular. Dan says, thoughts on hedged versus non-hedged ETFs? Yeah, sometimes a combination can be good, although it really depends on what your approach to the strategy is. A bit of currency exposure is okay, but if you're investing into non-hedged ETFs, I just want to be really mindful of, if you're investing in all-time highs or lows with the dollar, then that's potentially an issue. If you're investing around the average, then it can be less of an issue. So something to just keep in mind, Dan. Hope you found that one helpful. Guys, really appreciate all these questions. There's a ton here. I'm going to power through a few more. How do you keep big picture amidst all the caveats and risks involved in these investments? Well, you stick to the strategy first. So strategy and plan first. It's a really great question. And then work through the issues underneath that. So we know what we're going for, and then we can tick off the trade-offs and then ultimately choose whatever the best option is for you. Any advice on CFDs from Dexter? Look, I generally stay away from those. It's can be quite volatile and risky. A lot of people blow up a bunch of cash, so it's not really my something that I think. It sort of goes back to my comments on not needing to shoot the lights out with your investments. Joy says, micro investing apps good for retirement? Yeah, they absolutely can be. They absolutely can. They're pretty cost effective if you're investing regularly as well. But if you're just holding the funds there and you know exactly what you're doing and you're not adding to it, then I don't know, you just want to make sure that you're exploring your options so that you're paying the right amount in fees and that sort of stuff as well. Thoughts about Forex investing? Is it a good investment? My answer would be similar to the CFDs. I tend to stay away for that, from that stuff. I'm going to answer 3 more questions, and then guys, we'll send around a note as well off the back of today, just with the slides and recording and stuff. And if you've got any specific questions, please feel free to shoot them through. Investment return, are investment returns taxed under minors tax bracket? Marie says the focus call offer free. Yes, it is, Marie. It's no cost to you. You can just book directly through the calendar there. Varun, yeah, investing into a minor's name is there's different tax rates that a lot of people that we help set up investments for their kids choose to do that in their personal name. CC says, love your opinion on crypto. I like crypto as part of an investment portfolio, not as an entire investment portfolio. I just did a presentation on crypto, so check out our website. You'll find some more stuff on that there. I dive pretty deep into that, CC, so that should be helpful. What do I need to consider when investing with family or mates? Yeah, it's that you tie up your cash with them and it impacts your ability for future investments, Amy. Guys, really appreciate it. I've got a ton of questions there, so appreciate the enthusiasm. We'll send that note around and hit us up if there's anything specific. Check out those focus calls as well if you want to chat through what the options are for you. And we've got like 4 more events happening in this series, so jump onto the GA website, search for Ben Nash, and you'll see those coming up. Would love to see you there.
Hi, Ben.
Thanks, Kate.
That's a great presentation, and thanks to everyone that was joining us live and online today. Before we go, if you want to pause everyone for 50 minutes for feedback.